If you run an S-Corp with just 3 shareholders and you miss your Form 1120S deadline by 3 months, the IRS hits you with $2,295 in penalties alone, and that is before your state even sends its bill. Now, here is the real cost of getting this wrong. A sole proprietor earning $200,000 in net profit pays $28,234 in self-employment tax every single year. But that same business, structured as an S-Corp with the right salary, drops that bill to $15,300. That is a verified $12,934 in annual savings. By the end of this video, you will know exactly how to set your S-Corp salary, pick the right state strategy, and maximize your retirement contributions, all based on 2026 IRS rates. And I will show you the one mistake that turns a $12,934 savings into a $3,060 penalty. If you are a business owner, a 1099 contractor, or thinking about switching from a sole proprietorship to an S-Corp, this video is for you. Quick reminder, I am a tax educator, but I am not your CPA. This is for educational purposes only. Always run these strategies by your own licensed tax professional before you file. So how does the S-Corp actually save you money? It all comes down to self-employment tax. As a sole proprietor, you pay 15.3% on all of your net profit. But with an S-Corp, you split your income into 2 parts. A W-2 salary that gets hit with payroll taxes, and distributions, which do not. That split is where the savings live. But the key is getting 3 things right: your salary, your state filing, and your retirement setup. Get any one of those wrong, and the savings disappear. There is actually a way to check all 3 of these before you file. I will show you that tool later in this video. Let us start with states, because where you live changes everything. California is the most expensive state for S-Corp. Every year, you owe $800 in franchise tax, even with 0 revenue. On top of that, California charges 1.5% of your net income. No exceptions. So if your S-Corp earns $200,000 in California, here is the math. $800 franchise tax plus $200,000 times 1.5%, which is $3,000. Your total California state tax is $3,800 per year. And that is before any federal liability even kicks in. And if you file late, the IRS charges $255 per shareholder per month. For a 3-shareholder California S-Corp filing 4 months late, that is 3 times $255 times 4 months. $3,060 in federal penalties alone. California then stacks its own penalties on top of that. Now compare that to Texas. Texas has no state income tax at all. S-Corp only pay a franchise tax if annual revenue exceeds $2.65 million. For the vast majority of small S-Corp owners, Uber drivers with multiple vehicles, Etsy sellers scaling to a team, independent contractors, the state tax bill is $0. New York falls somewhere in between. S-Corp pay a fixed minimum tax based on receipts, ranging from $25 to $4,500 depending on your revenue tier. Not as cheap as Texas, but nowhere near California. Here is the quick comparison. California charges $800 minimum plus 1.5% of net income with no threshold at all. Texas charges $0 for most small businesses with a $2.65 million revenue threshold. And New York charges $25 to $4,500 based on your receipts, with the tax passing through to shareholders. But here is where most S-Corp owners get into real trouble. It is not the state filing, it is the salary. The IRS requires every S-Corp owner to take a reasonable W-2 salary before taking any distributions. This is not optional guidance, it is an enforcement priority. And they are actively looking for people who get this wrong. Here is what happens when you get it wrong. A CPA named Watson paid himself just $24,000 from his S-Corp while taking the rest as distributions. The IRS reclassified those distributions as wages. The court upheld it. He owed back taxes, penalties, and interest. The Supreme Court refused to hear his appeal. That case is still the controlling precedent today. And someone on TikTok will tell you to pay yourself $10,000 and take the rest as distributions. The IRS will tell you that is the fastest way to get audited. Watson paid himself $24,000 and still lost. So imagine what happens at $10,000. So why does the salary matter so much? Social Security tax is 12.4% on wages up to $184,500. Medicare is 2.9% with no cap at all. Together, that is 15.3% in payroll taxes on every dollar of your W-2 salary. That is money you cannot avoid on the salary portion. Let us run 3 scenarios for a $200,000 net profit S-Corp. First scenario, you take $100,000 as salary and $100,000 in distributions. Your payroll tax bill is $15,300. The IRS considers that low risk. Second scenario, $60,000 salary, $140,000 in distributions. Payroll tax drops to $9,180, but you need documentation to defend it. Third scenario, $24,000 salary. Payroll tax is just $3,672, but that is Watson territory. That is an audit waiting to happen. So what counts as reasonable? The IRS looks at 5 factors. 1. The type and extent of services you provide. 2. How scarce qualified employees are for your role. 3. The volume of business you handle. 4. What comparable businesses pay for that same position. And 5. General economic conditions in your area. Write this down. You need comparable salary data from the Bureau of Labor Statistics or an industry survey or a CPA prepared compensation analysis. When the IRS examiner asks, and they will ask, you need to show exactly why your salary matches the market rate for your role. This one gets complicated depending on your situation, so definitely loop in your tax professional before applying it. And if you want to check whether your salary and deductions are defensible before you file, that is exactly what PreFile Check helps you verify at prefilecheck.com. Now let us talk about the part most S-Corp owners completely overlook. Retirement. Here is the critical rule that changes everything. Only your W-2 wages count for retirement contributions. Distributions do not count as earned income. So if you set your salary too low to save on payroll taxes, you are also capping how much you can put away for retirement. The Solo 401k offers the highest contribution limits for 2026. Employee deferral, $24,500. If you are age 50 to 59, add $8,000 in catch-up contributions. Ages 60 to 63, get the super catch-up, an extra $11,250. Employer contribution, up to 25% of your W-2 salary, and the combined annual cap is $72,000. Here is a real example. You are 45 years old with $100,000 W-2 salary. Employee deferral, $24,500. Employer contribution, $100,000 times 25%, that is $25,000. Total sheltered from income tax in 2026, $49,500. That is money growing tax-free until you retire. What about a SEP IRA? It is simpler to set up and has no annual Form 5500 filing, but it only allows employer contributions. No employee salary deferrals. At the same $100,000 salary, the max SEP contribution is $25,000 compared to $49,500 with a solo 401k. That is a $24,500 difference in tax-sheltered savings every single year. One more thing about retirement accounts. If you pull money out of your solo 401k or SEP IRA before age 59 and a half, you owe a 10% penalty on top of ordinary income tax. The exceptions are limited. Permanent disability or separation from service at age 55 and older. But there is no exception for needing the money for your business. None. Ready to make the switch? Before you file anything, check 4 requirements. Maximum 100 shareholders, only one class of stock. All shareholders must be United States citizens or resident aliens, and the entity must be a domestic corporation or an LLC electing corporate treatment. If you fail any of these after election, your S-Corp status is automatically terminated. That is a retroactive tax disaster. File Form 2553 by March 15th of the tax year you want the election to start. Miss the deadline? Do not panic. Late election relief is available. You can file within 3 years and 75 days of your intended effective date with a reasonable cause explanation attached. After your election goes through, here is your compliance checklist. Set up payroll for your W-2 salary using a service like QuickBooks Payroll or Gusto. Open a dedicated S-Corp bank account because commingling funds destroys your corporate protection. File Form 1120S by March 15th every year. Issue Schedule K1 to each shareholder by the same deadline, and register with your state. So when does the S-Corp election actually pay for itself? Most CPA practices say the break-even point is $40,000 to $50,000 in annual net profit. Below that, payroll administration costs eat up the tax savings. But above $50,000, the numbers start working in your favor, and the higher you go, the bigger the gap. Get the salary right. Get the state filing right. Get your retirement contributions based on W-2 wages, not distributions. Those 3 steps determine whether your S-Corp saves you $12,934 a year or creates the liability you are trying to avoid. Want to check if your S-Corp setup is defensible before you file? That is exactly what PreFile Check does. Head to prefilecheck.com and run the numbers before the IRS does. If you are a business owner, a 1099 contractor, or thinking about making the switch to an S-Corp, hit subscribe right now. Every week we break down the tax strategies that actually save you money, backed by IRS code and federal case law, not TikTok advice. Now I want to hear from you. Are you already running an S-Corp, or are you still deciding if the switch is worth it? Drop your answer in the comments below.